I am OG John, original. On Monday, March 2nd, 2026, silver markets experienced a sharp and sudden price decline that sent shockwaves through retail trading communities across the country. Silver, which had closed the previous Friday at $93.18 per ounce, dropped to a session low of $87.92 during Monday's trading session, a single-day decline of $6.26. The move came against a backdrop of significant geopolitical turbulence, with an ongoing military operation referred to as Operation Epic Fury continuing to escalate across the Middle East, driving crude oil futures to their highest levels since the original Iran sanctions crisis, and pushing the Dow Jones Industrial Average down 400 points in a single session. What made Monday's silver price action particularly notable was its apparent contradiction of broader market behavior. On the same day that gold, Bitcoin, and the Swiss franc were all moving higher, assets traditionally associated with safe haven demand during periods of geopolitical instability, silver moved sharply in the opposite direction. That divergence prompted widespread reaction among retail investors, many of whom had entered silver positions ahead of the session, anticipating a move toward the $100 price level. According to analysis published the same evening, the price decline was not characterized as organic market selling. Instead, the move was described in detail as a coordinated algorithmic stop-loss hunting operation, a tactic in which large institutional players deliberately drive prices lower to trigger automated sell orders placed by retail traders, allowing those institutions to acquire positions at reduced prices before a subsequent recovery. The silver price did, in fact, recover substantially from its intraday low, closing the Monday session at $91.40, nearly $4 above the session bottom. To understand the full scope of what occurred on Monday, March 2nd, 2026, it is important to examine the precise sequence of events as they unfolded throughout the trading session. Silver opened in overseas markets on Sunday night, carrying forward its Friday closing price of $93.18 per ounce. When New York markets opened at 8:30 in the morning Eastern Time, the price remained relatively stable, hovering near $92.80. At that point, the geopolitical backdrop was already significant. Reports over the weekend had described missile strikes, burning oil facilities, and emergency sessions of the United Nations Security Council, all developments associated with the continued escalation of Operation Epic Fury in the Middle East. Despite that environment, silver began declining gradually in the early portion of the session. The price moved from $92.50 down to $92.20, then to $91.90. The decline, while steady, remained relatively measured during this initial phase. That changed dramatically at 10:17 in the morning Eastern Time. According to the analysis published Monday evening, silver dropped from $91.50 to $89.12 in under 4 minutes. The price then continued lower, reaching $88.60, then $88.10, before hitting the session low of $87.92 at 10:23 in the morning, exactly 6 minutes after the initial sharp decline began. The speed and concentration of that move was cited as a key indicator of its algorithmic origin. The analysis noted that the volume profile during the session supported this characterization. Trading volume spiked sharply during that specific 6-minute window between 10:17 and 10:23, and then collapsed almost immediately afterward. The remainder of the trading day was described as relatively quiet by comparison. That pattern, a concentrated burst of heavy volume followed by an abrupt return to low activity, was identified as inconsistent with organic investor selling, which would typically produce sustained elevated volume across a broader portion of the session. Central to understanding why this type of price action occurs is the concept of stop-loss hunting. When retail traders place positions through major brokerage platforms, they commonly attach stop-loss orders, automated instructions that trigger a sale if the price falls below a specified level. The analysis explained that institutional players and high-frequency trading firms have access to order book data that reveals where large clusters of these stop-loss orders are positioned. With silver having closed at $93.18 on Friday, and with significant retail interest having built up over the preceding days, a substantial concentration of stop-loss orders was described as likely sitting just below the $90 level, at price points such as $89.50, $88, and $87. By executing a large, coordinated sale of paper futures contracts in a compressed time frame, institutions can push the price through those stop-loss levels, triggering a cascade of automatic retail selling. Once those orders execute, the same institutions are positioned to purchase the resulting supply at the depressed price, before the market stabilizes and begins recovering. The silver price's rapid return toward $91.40 by the close of Monday's session was cited as consistent with that sequence of events. Beyond the mechanics of Monday's price action, the analysis published that evening outlined several fundamental factors described as underpinning the broader silver market situation. The first of those factors was identified as a physical supply deficit. Citing data from the Silver Institute, the analysis noted that global silver supply and demand figures for 2026 point to the largest physical deficit in the history of the modern silver market. Industrial demand, driven particularly by solar panel manufacturing and electric vehicle production, is consuming silver at a rate that exceeds current mine output. The projected deficit for the year was cited at over 200 million ounces. At the same time, the analysis noted that above-ground stockpiles available to meet that deficit have reached multi-decade lows. Registered silver inventories at the COMEX, the exchange through which silver futures contracts are traded and physically settled, were described as having declined for 3 consecutive years, falling to under 50 million ounces of registered silver currently available for delivery. The analysis characterized the mathematical relationship between a 200 million ounce annual deficit and a sub-50 million ounce available inventory as fundamentally unsustainable under current market conditions. The second factor discussed was the geopolitical environment. The analysis described the current Middle East crisis, centered on the ongoing Operation Epic Fury military operation, as the most serious regional conflict since the Yom Kippur War of 1973. Specific developments cited included missile strikes, retaliatory drone attacks, and the targeting of oil infrastructure. The analysis noted that historically, periods of comparable geopolitical instability in the Middle East have been associated with significant increases in precious metals prices, driven by demand from central banks, sovereign wealth funds, and institutional money managers seeking assets that cannot be frozen, sanctioned, or devalued through monetary policy. The third factor outlined in the analysis concerned regulatory changes. A framework referred to as Basel IV, described as a new international banking regulation that took effect in January of 2026, was identified as a significant development for precious metals markets. According to the analysis, Basel IV reclassifies physical gold, and by extension physical silver, as a Tier 1 asset on commercial bank balance sheets. Under this classification, banks can hold physical precious metals as core capital reserves with zero risk weighting, treating those holdings on equal terms with cash or sovereign bonds. The analysis described this regulatory shift as creating a direct institutional incentive for commercial banks to accumulate physical precious metals in order to strengthen their balance sheet positions. The analysis also drew a distinction between the paper futures market and the physical silver market, describing the two as increasingly disconnected. It noted that futures contracts traded on the COMEX are settled in cash in the vast majority of cases, with physical delivery occurring in only a small fraction of transactions. The analysis characterized this structure as a fractional reserve system for precious metals, in which a large number of paper contracts can exist relative to the amount of physical metal actually held in exchange vaults. Reports were cited of retail coin dealers across the country, charging premiums of $15 to $25 over the COMEX spot price for physical silver eagles and maple leaf coins, meaning that even as the paper price reached $87.92 on Monday, the effective purchase price for physical silver at the retail level was described as ranging from approximately $102 to $112 per ounce. That divergence between the paper spot price and the physical transaction price was presented as evidence that market participants directly involved in the physical silver supply chain are operating on a different pricing basis than that reflected in the futures market. The analysis described the premium levels being charged by wholesale and retail dealers as a reflection of actual physical scarcity rather than the price discovery occurring through paper futures trading. To summarize the events and analysis covered in this report, Monday, March 2, 2026, marked a significant and closely examined session for silver markets. The metal declined from a Friday closing price of $93.18 to an intraday low of $87.92 before recovering to close the session at $91.40. The $6.26 decline unfolded against a backdrop of escalating geopolitical tensions tied to Operation Epic Fury in the Middle East, rising crude oil futures, and a 400-point decline in the Dow Jones Industrial Average, a set of conditions that, under conventional safe haven demand logic, would typically be associated with rising rather than falling precious metals prices. The analysis published Monday evening described the price decline as the product of a coordinated algorithmic stop-loss hunting operation rather than organic investor selling. The evidence cited in support of that characterization included the compressed 6-minute time frame of the sharpest portion of the decline, the concentrated volume spike during that specific window, followed by an immediate return to low trading activity for the remainder of the session, and the rapid price recovery of nearly $4 from the session low before the close of trading. The analysis identified these patterns as consistent with institutional accumulation tactics rather than broad-based retail liquidation. Three fundamental factors were outlined as forming the backdrop against which Monday's session occurred. First, the Silver Institute's 2026 supply and demand data was cited as projecting the largest physical deficit in modern silver market history, estimated at over 200 million ounces, against registered COMEX inventories described as having fallen below 50 million ounces following 3 consecutive years of drawdowns. Second, the geopolitical situation surrounding Operation Epic Fury was described as the most serious Middle East conflict since 1973, with missile strikes, drone attacks, and oil infrastructure damage all cited as active developments. Third, the Basel IV International Banking Regulatory Framework, which took effect in January 2026, was described as reclassifying physical precious metals as Tier 1 balance sheet assets for commercial banks, creating new institutional demand incentives that were not present under previous regulatory structures. Additionally, the report highlighted a growing divergence between paper futures prices and physical silver transaction prices at the retail level. Dealer premiums of $15 to $25 over the COMEX spot price were cited as evidence that physical silver was not actually transacting at the $87.92 level reached during Monday's session, with effective retail purchase prices described as ranging between approximately $102 and $112 per ounce at coin shops across the country. The broader macroeconomic context referenced in the analysis included a United States federal budget deficit described as running at $2 trillion annually, a national debt cited as having crossed $36 trillion, a Federal Reserve balance sheet described as carrying over $7 trillion in bonds accumulated during and after the COVID-19 period, ongoing stress in the commercial real estate sector, pressure on regional banks, and active efforts by BRICS nations to reduce dependence on the US dollar in international trade settlements, including reports of China and Russia settling oil transactions in yuan and rubles, and indications that Saudi Arabia is considering accepting non-dollar currencies for oil payments for the first time in 50 years. Monday's silver market session and the analysis it generated reflect the complexity of precious metals pricing in an environment shaped simultaneously by geopolitical instability, evolving financial regulation, reported physical supply constraints, and the mechanics of high-frequency algorithmic trading in paper futures markets. This has been a full broadcast report on the silver market developments of March 2, 2026. We will continue to monitor and report on further developments as they emerge.